Hello everyone, welcome back to our channel. Have you ever wondered how economists actually figure things out? And what's the deal with micro and macroeconomics? Sounds complicated, right? Well, stick around. Today we are demystifying how economists work and will break down micro versus macro in super simple terms. No complex maths, just the core ideas, okay? Let's just dive in. So, how do economists study things like your shopping habits or why prices goes up? They use a kind of scientific method. Okay, they basically observe what is happening, make an educated guess or hypothesis about why, then test it with the data, and then they build simplified models like maps. Okay, they do this to understand the important bits without getting lost in the details. Okay, so that is how they basically read different data. What they do is they observe, they hypothesis, they test it with the data, and then they build simple models. Okay, they also try to stick to positive economics and normative economics. Now, positive economics basically describes what is. This is based on facts. Like, for example, higher prices will lead to less demand. It is a fact. So, those are the part of positive economics rather than just normative economics. Normative economics basically describes on what should be. Okay, which is about opinions. This is not about facts. So normative economics is more about opinions. Like government should basically lower petrol prices to help consumers. Now this is an opinion. Okay, now both of these are useful, but knowing the difference between positive economics and normative economics is the key. Okay, now the main event. Economics basically splits into two big branches. It's like looking at the world through say different lenses. Okay, so microeconomics basically is the zoom in lens. It's completely focused on very micro thing. It is a zoom in lens. And macroeconomics is a wide angle big picture lens. Okay, so these are the two branches there, microeconomics and macroeconomics. Let's start with microeconomics. Microeconomics is you basically think small. It focuses on individual pieces of the economy. Okay, it asks questions like why did you choose that brand of coffee? That will be say individual consumer choice. It asks questions like how does one specific company like say Pizza Hut in your location decide its prices? That's firm behavior. Microeconomics asks questions like what happens to the price and availability of your present smartphone if a new model comes out. Okay, that is again comes under your microeconomics because it's specific market supply and demand. Okay, now micro is all about the decisions of individual people, single business and specific markets. It's the building blocks. Okay, now let's actually zoom out with macroeconomics. You have to think large or whole. Now macro looks at the entire economy of the country or even the world. Okay, it tackles the big questions. Okay, now macroeconomics basically deals with the entire country's economy growth. It asks question if the economy is growing or the entire country's economy is shrinking. That falls under GDP. It asks if the prices are overall going up very fast. That is inflation. Okay, it asks how many people across the whole nation are unemployed. That is unemployment rate. Now all these fall under macroeconomic policy, macroeconomics. Okay, even policies like fiscal or monetary policy, they also fall under macroeconomics. Now macro deals with the aggregates, the sum totals for the whole economy. It's the complete forest, not the individual trees. Okay, micro are basically the individual trees. Macro is a complete forest. Okay, but here is a cool part. Micro and macro are totally connected. They are interconnected. What happens in macroeconomics, for example, like recession, is made up of millions of microeconomic decisions. Okay, like say people spending less, firms hiring fewer workers. All these microeconomic decisions will affect macroeconomics. And the big macro policies like say fiscal policy, changing interest rates, etc., they affect your individual micro choices, like whether you take out a loan or not. That would depend on if the government is increasing the interest rate or decreasing the interest rate. Okay, so you need both to really understand what is going on. Okay, now why do we split them? Why do we have to divide economics into two, both micro and macro? Because they ask different questions and often they need different tools or models to answer them. Now micro helps us understand how markets work efficiently, and macro helps us understand that the overall health and direction of the national economy. That is the basic reason we basically have to divide it into micro and macro. Okay, all right. Now let's do a quick recap. Economists use models and distinguish positive from normative. Positive is based on facts, normative is based on opinions. Now the field has two main branches. What are they? Good. Microeconomics and macroeconomics. Microeconomics focuses on individuals, firms, specific markets. Very good. Macroeconomics focuses on the whole economy, right? GDP, inflation, unemployment. It's the bigger picture. And they are different but deeply connected. Okay. Now, hopefully, micro and macro feel a lot less intimidating now. Okay. Understanding both will help you make sense of everything from your personal budget to global news. Okay. Now, if this video basically helped clear things up, please hit that like button and subscribe for more simple explanations of economic ideas. And do let me know which topic seems to be more interesting to you, micro or macro. Thanks for watching. Stay curious and see you next time.